When people think of finance, images of skyscrapers, bank vaults, and digital transfers often dominate the imagination. But long before formal banks reached many parts of Africa, communities developed ingenious systems to pool, save, and distribute wealth, systems that were trust-based, decentralized, and remarkably effective. These systems, known by names like Isusu in West Africa, Ajo in Nigeria, and Tontines across Francophone Africa, solved real economic problems using nothing more than social trust, organization, and collective accountability. Even today, these systems thrive, providing financial stability, business capital, and social cohesion in communities where formal banking might be inaccessible. How rotating savings systems work. At their core, systems like Isusu, Ajo, and Tontines are rotating savings and credit associations, ROSCAs. Here's the basic structure. 1. Group formation. A group of people, neighbors, family members, or colleagues agree to contribute a fixed sum of money at regular intervals, weekly, monthly, etc. 2. Contribution. Pooling. Each member deposits the agreed amount into a collective fund during each interval. 3. Rotation of payouts. The pooled sum is given in full to one member per period, rotating until all members have received the total at least once. 4. Repetition or expansion. Groups can continue cycles, often adjusting contributions or membership to meet changing financial needs. For example, in a 10-member group contributing $100 each month, one member receives $1,000 per month. After 10 months, everyone has had their turn, effectively providing interest-free loans or lump sums without banks or formal credit systems. Isusu, West Africa's community bank. In Yoruba and other West African societies, Isusu has been a cornerstone of financial life for centuries. Beyond simply saving money, Isusu groups serve as microcredit systems. Participants can use their payouts to start businesses, purchase goods, or cover urgent expenses. Community enforcement. Social pressure ensures everyone contributes on time. Defaulting can result in loss of trust or exclusion from future rounds. Collective investment. Some groups pool funds to invest in community infrastructure or group enterprises. SSU operates entirely on trust and social norms. There is no formal legal framework, yet the system is highly effective because participation is tied to reputation, accountability, and mutual benefit. Ajo, Nigeria's rotating fund system. In Nigeria, Ajo functions similarly, but often has additional layers of organization. Registered leadership. Groups elect leaders who manage contributions and organize payouts. Flexible schedules. Contributions can be weekly, bi-weekly, or monthly, depending on the group's needs. Loan facilities. Some Ajo groups allow members to borrow a portion of the pool ahead of their rotation, repaying it with agreed adjustments. Ajo exemplifies how informal banking systems adapt to local contexts, blending financial practicality with social cohesion. Many small-scale entrepreneurs rely on Ajo to fund business ventures, purchase equipment, or pay school fees. Tontines, Francophone Africa's social credit system. In West and Central Africa, particularly in Francophone countries, tontines serve as another variant of the rotating savings system. Collective responsibility. Each member contributes regularly, and the pooled fund is awarded on a rotating or lottery basis. Extended networks. Tontines often connect members across neighborhoods or cities, creating inter-community trust networks. Economic impact. Tontines provide access to lump sums that can be invested in trade, property, or education, allowing members to bypass formal banking barriers. Tontines also function as insurance networks, enabling members to access funds during emergencies or crises, demonstrating the system's flexibility and resilience. Why these systems work. Rotating savings systems, such as Isusu, Ajo, and Tontines, succeed where formal banking might fail because they rely on social capital rather than collateral or formal legal enforcement. In many communities, access to banks is limited by geography, income level, or documentation requirements. Traditional banks often require credit history, proof of income, or formal identification, barriers that exclude large segments of the population. Rotating savings systems bypass these obstacles by leveraging trust, accountability, and shared responsibility within the community. On reading, trust at the heart of these systems is trust, both personal and collective. Participants contribute money to a pool with the understanding that everyone will uphold their obligations. Reputation within the group is paramount. Financial compliance is socially enforced. A member who fails to contribute risks damaging relationships, losing face, or being excluded from future cycles. Community oversight replaces formal enforcement. In small villages or tight-knit neighborhoods, everyone knows each other, so defaults are rare. Moral and social incentives ensure commitment. Participating successfully reinforces a person's credibility, while failing undermines social standing. In essence, trust is the currency that underpins the system, allowing participants to pool significant resources with minimal formal oversight. 2. Accountability. Accountability in rotating saving systems is direct and immediate. Each member's contributions are visible to the group, often documented manually or verbally confirmed in regular meetings. Peer pressure and communal responsibility encourage timely participation. Members often rotate leadership or stewardship of the fund, ensuring transparency and minimizing opportunities for mismanagement. This type of peer enforcement can be more effective than formal legal systems, especially in regions where courts are slow, expensive, or inaccessible. By placing responsibility on the group itself, the system fosters self-regulation and high compliance rates. 3. Flexibility. Unlike traditional banks, which impose rigid requirements, rotating saving systems are adaptable to the members' financial realities. Contribution amounts can be tailored to each participant's income or capability. Payout schedules are negotiated to match urgent or seasonal needs, such as harvest periods or festival expenses. Group size can expand or shrink depending on trust, availability, and social ties. This flexibility allows the system to respond to the unique economic conditions of a community, making it inclusive and accessible to people who might otherwise be excluded from formal banking services. 4. Collective benefit. These systems are built on mutual support rather than individual gain. Members benefit not only when it is their turn to receive the pooled sum, but also when others succeed financially, creating a shared interest in collective prosperity. By providing access to lump sums, the system allows participants to seize business opportunities that would otherwise require loans or credit unavailable to them. In many West African cities, entire marketplaces rely on isusu cycles to finance daily trade, fueling microeconomies without formal banking infrastructure. Education families frequently use their payouts to pay school fees, buy uniforms, or purchase textbooks. In some communities, isusu groups are specifically organized to save for collective educational goals, enabling students to continue schooling even in low-income contexts. This function transforms the system into a tool for long-term human capital development, not just immediate financial relief. Emergency support, modern relevance. Despite the proliferation of mobile banking and microfinance, rotating saving systems remain popular across Africa and in diaspora communities worldwide. Digital platforms now allow mobile isusu or aho groups, combining ancient principles with modern technology. Mobile money apps facilitate contributions, tracking, and payouts. Group accountability is reinforced digitally, reducing the need for physical meetings. Diaspora communities use digital tontines to support relatives back home, creating cross-border trust-based finance networks. The enduring relevance of these systems demonstrates that finance does not require formal institutions to work effectively. With trust, organization, African rotating saving systems, isusu, ajo, and tontines demonstrate that wealth creation, credit, and economic security are not confined to banks and formal financial institutions. Rooted in trust, social cohesion, and collective accountability, these systems have enabled communities to fund businesses, cover emergencies, and support one another for centuries. Even today, these traditional systems thrive, often enhanced by mobile technology, proving that the principles of community-based finance remain powerful and adaptable. Africa's legacy of innovative, trust-driven finance reminds us that economic solutions are not always about technology or regulation. They are about people, relationships, and collective responsibility. Engage with history and finance. If you found this exploration of African community finance fascinating, subscribe for more stories uncovering Africa's innovations in economics, science, and engineering. Leave a comment below. Have you ever participated in a rotating savings system? How do you think trust-based finance can inform modern banking?